Good morning, Jags. This is Fahad. Today is Monday, October 19th. Let's get started. I want to cover Virgin Galactic SPCE real quick here. This stock on Friday was starting to break out from tight bull flag. And as you can see right over here, although towards the end of the session, the entire market has started to roll over, fade a little bit. Nasdaq gave up about 120 points in the final hour of trading on Friday. So as a result, Virgin Galactic ended up closing well below its session highs on Friday. But I'm looking at pre-market session, and it's going to have a little bit of a gap higher again, about 40 to 50 cents, which on a percentage basis, about 2% gap higher. Up until half hour ago in pre-market, this was actually already taking out the Friday's high. So there's relative strength here to notice. And as you know, as we have covered previously, that the key remains the first space flight that is expected with 2 pilots, and that's supposed to happen sometime pretty soon. Here's another article out. This one comes from interestingengineering.com. And in this case, they're also talking about the first Virgin Galactic is set for the first spaceport flight. This is going to happen from New Mexico, I believe, from their facility over there. It is still not sure whether this thing is going to happen by the tentative date, which the company had confirmed, which was October 22nd, which would be this week. October 22nd will be Thursday of this week. As you can see right here, though no specific date has yet been given for the first space flight to launch from Spaceport America, the first flight or the flight planning window has been confirmed to start on October 22nd, meaning the launch could happen from the next week onwards. But the company has also stated in a press release that came out last week that it could be sometime in the fall. So once again, we do not know if it's going to be this week or if it's going to be next week, but we know the preparation is underway. And what this stock is really doing, it's starting to act strongly ahead of that event. Now, we'll see exactly what the event looks like, but Friday was a very high volume rally with a breakout from bull flag. It seems to continue to march higher into that event. Major VOP resistance remains around $25 per share. So let's see how this stock is going to react today. We do have a bullish trade out. I do have call options as well as common stock position in this name. Lastly, I want to point out, if you go to the Jaguar scans, the bullish accumulation patterns, and this has been very, very strong. This is just looking at the data that was filled on the offer beginning really from middle of May, and you can see that it has been consistently bullish with an 84-85% bullish bias. Remember, Jaguar scan is built to pick up any option activity that takes place on the offer with no connections to the common stock position, and the number of contracts have to be above certain amount. The number of dollars has to be above $10,000 bet, and such and such. So basically to remove anything else but look at pure bullish flows and bearish flows. In this particular case, since the beginning of May, we have seen the position or the activity maintained consistently above 80% bullish bias. So let's see how this thing is going to do today, and I wanted to start off with that. Now, another stock that I'm watching closely today for a potential breakout is Tractor Supply, symbol TSCO. Tractor Supply closed at a little over $153 per share, and if you look at pre-market, this thing is going to slightly gap higher above $154 per share. And if you look at the chart, that $154 to $155 level happens to be a technical resistance. This is where the stock stalled last time, and it seems to be attacking that resistance in pre-market. Will it break out? We'll see. Here's another technical look. From a stock chart, you can see is a clear VOP resistance line right over here between 154 and 155. And then, as you know, as I've said many, many times, I love stocks that are coming up to major important resistance on rising volume. And that was the case. Now, clearly, Friday was also October expiration, so that may have played the part in this one. Nevertheless, this is a tight bull flag near 52-week high, and the volume has been as strong as the stock is coming up to resistance. And in pre-market, this is starting to, is closing. It's already trading above the Friday's high. So keep an eye on this one, Tractor Supply. Now, the reason for this one is going to be likely a bull case that is coming out from RBC Capital today, in which they are raising earnings estimates on strong earnings momentum for the company. I will quote over here. We are raising our third quarter comp estimates to 24% year over year from 15% previously, and consensus estimate of 16.4%. We're talking, this is the same store sales growth we're talking for this company, a 24% same store sales growth for the third quarter, versus the company gave the guidance between 12 and 18%. So if you take the midpoint of that, that was 15%. So this would be very, very strong based on where the RBC Capital is going right now. And they also say that their third quarter earnings estimates is going higher to $1.45 versus $1.25 estimate. And they believe that new customers, the retail lift and rural migration should continue to drive top line momentum. We believe that multiple factors will continue to drive comp growth well above historical rates. Three key reasons for that. Number one is that they believe the company has successfully acquired many new customers following the initial lockdowns, and now have those people as part of the overall customer ecosystem. And secondly, they say that the retail lift that they're seeing should continue to fuel strong demand for Tractor Supply offering, including reallocation of dollars away from other discretionary categories like travel, entertainment, events, and dining. And lastly, they say that COVID-19 has catalyzed a migration pattern from urban areas to suburban areas, and towards more of its location, bringing in higher amount of traffic. So you can see that the migration, particularly that story we have been talking about a lot. We have covered that many, many times, from urban to suburban. And so these trends are, including channel checks, they believe are all very, very positive. I will also tell you that there's a key note over here that is worth mentioning, which is right over here. Let me bring that up to your screen. So if you look at this, they say that the company this week on Thursday, so write that down, the company is hosting a 3-hour enhanced earnings event in which they're going to present a lot of presentations from key executive leadership team. And in this quarter, what the analysts would like to see is they would like to see that the spending, there's more spending per trip, and buying across more categories during the second quarter, and they expect this to continue in the third quarter. And in the last quarter, in the second quarter, the company saw a 3.3 million increase in new customers, which was a 14% year over year, and nearly 2 million re-engaged customer, the existing customer base that is, it was a 40% year over year. So these trends are very, very positive. And if the company says that third quarter was no different, I think then there's a setup here for a technical breakout, maybe towards $160 to $165 per share in short term. All right, so I'll be keeping an eye on this, and I might jump into some short-term call options ahead of that catalyst and the breakout. That's it from me. Jay?
Morning, everyone. Today, taking a look again at Corsair Gaming, ticker CRSR. So we covered this gaming products company for the first time in conversations back on September 29th. We then actually brought it up again on Friday in chat. Well, this morning, the initiation notes have arrived. We've mentioned a few in first read, and I was actually looking at both Credit Suisse and Stifel. There's a lot, of course, to kind of go through, dive into, because they are initiation notes. Stifel's note is nearly 70 pages. Credit Suisse is over almost 45 pages. But a couple of the items that have stood out to me, number one, Credit Suisse talks about how the growth for this company has recently come from the acquisitions it has made over the past few years. More specifically, in June 2018, it acquired streaming gear vendor Elgato. In July 2019, it acquired pre-built PC vendor Origin, and then most recently in December of 2019, it acquired Scuff Gaming, which was their entry into high-performance controllers. So based on the analysis of these respective markets, Credit Suisse expects Elgato and Scuff to drive outsized growth for the company ahead. specifically for the streaming market, based on a growing streamer count, which I'll mention in a little bit, and then a healthy spend on gear per streamer. They anticipate a 2.5 billion streaming gear total addressable market by 2025. And then for performance controllers, this model is built around the PlayStation, Xbox, and then of course you have your upcoming next gen systems. This market yields an $800 million market size. I should say it yields this number, this 800 million by 2023. So in total, combined, these combined markets will rise to over 3 billion by 2025. Now, sticking with the streaming topic, due to COVID, they mentioned that average Twitch viewership surged 55% from April to September. And not surprisingly, the growth in viewership data has also translated over to expansion in the number of streaming content creators. There were 7.5 million streamers active on Twitch in September. This was up from just 3.3 million in December of 2019. So they then go on to talk about with the data that they have, they built their own bottom-up total addressable market using Twitch as the proxy. And they estimate up to $5 billion in annual spending for streaming gear by 2025. Now, one of the things that they do comment on, because Twitch is ultimately, the market share taker right now, what they're not anticipating, or what they're not factoring in, are other opportunities, other platforms. If Mixer, for example, had survived, that would have been another opportunity. But then you look at C Limited, for example, they have their own platform in Booyah. So essentially right now it's just focused on Twitch, but additional platforms could certainly drive this number higher. And then when you look at the breakdown of what a streamer could potentially buy, let me just quickly share a image with you. Yeah, so they break down 3 different scenarios for products a streamer could buy. And at the low end of everything, if a streamer just bought, a microphone and lighting, you're looking at $260. But then if you add in capture cards and green screens at the high end, you're looking at $1,000. So essentially, the streaming market should be a huge growth driver for this company going forward.
Yeah, this is all very interesting. And just to remind everybody that here is the video in the conversations on September 30th or September 29th rather. Then when you first covered this brand new IPO, and then talking about the company posted is growing 42% year over year. And then also here is my comment last week in webinar. Where did it go? CRSR. Here you go. In which I talked about this briefly. Now, one of the things that I was thinking about is, like, did they misprice this IPO? Did they misprice this IPO too cheap? Here's a 5-year chart in front of you, and if you look at the 1-year chart, you will see that unlike many of the other hot IPOs that came to the market, which immediately started to see some fading action because they were priced so high, right? This one immediately started to run and had a fantastic run over the course of first week or so, rising from 14 to 22. And since then, it has corrected and basically consolidating and building a base here around $18 to $19 per share. I say, did they misprice this IPO? Because this company has a market capitalization of, or it trades at only 1.2 times sales, which are growing 42% year over year. Now, I understand that the hardware companies usually don't get a high multiple anyway, but similarly, if you go to Logitech, which seems to be the best peer, and I understand Logitech is much more diverse and everything, this thing trades at 4.5 times sales. And it does not have the same kind of growth rate. It grows at 23% year over year from all the COVID-related disruptions that are taking place. So real question is that with the digital gaming, on the rise, did they misprice it? 40% year-over-year growth rate, trading at 1.2 times sales. And secondly, with the new game consoles that are coming out with the Xbox and the PS5, I wonder if it's going to recharge the bulls in the hardware category, so the growth rate will not only remain strong, but potentially will accelerate further with the new kind of gamers jumping into this market going into the holiday shopping season. The next couple of quarters could be very, very bright. These are all the questions in my mind, and that's why, the price action as well as the valuation metrics and everything else that I've read from the S1 filing just seems too attractive to ignore. Could be a big home run over the long period of time. Good stuff. Chronicle.
Morning. A couple of things caught my attention over the weekend. First thing is KeyBank's note on Chipotle from late last week. Note does have the latest checks on the company, but it needs to be stressed that overall it had more of a long-term view rather than a play on earnings, which is coming this week. So keep in mind, KeyBank is not trying to make a call on earnings here, and the stock has already run up a lot in the past quarter, to the point where their institutional investor survey indicates that 30% of respondents expect that the company needs to report double-digit comps in order to for the stock to move higher. But I think any dips post earnings would be a buying opportunity in anticipation of 2021. So first off, based on KeyBank's proprietary checks, strong sales growth in Chipotle's digital channels has persisted, albeit with a slight deceleration in recent weeks. Based on this data, weekly index spend growth in digital channels, which includes app, internet, and delivery, has increased over 165%, while at the same time the company has recovered more than half of its in-store sales. Additionally, this rapid digital growth has helped the mix sustain in the high 50s% range since the start of Q3, compared to 20s% pre-pandemic. And putting everything together, this implies roughly 50% digital revenue mix after delivery commissions. So those are the immediate checks. But looking further ahead, KeyBank is raising their 2021 EPS estimate from 10.95 to 21.62. And they've also introduced 2022 EPS estimate of 27.73. So couple reasons for this. First of all, KeyBank believes Chipotle is still in the early stages of its digital journey. Like, the company has retained roughly 65% of its digital sales, even as it's recovered half of its in-store sales. And in future, the firm believes Chipotle will find a way to unlock value by offering a digital-only menu items in the future. They also believe that loyalty, which now has over 15 million members, that's going to allow for more personalized marketing. So that's point number one. Their second point is on the cost side. They're forecasting 2021 restaurant margins to improve by nearly 200 basis points to 22.4% due to COVID-related and cleaning supplies costs coming off. But KeyBank also says that they suspect their estimate will prove conservative if sales volumes quickly approach 2015 peak levels of 2.5 million per store, in which case they would expect margins to reach 25% rather than 22.4. So that's basically the main message of the note. This is a 12-month view that KeyBank is sharing, not an earnings play. So that's the first thing I have this morning.
Yeah, interesting. I do think the company will post a very strong quarter. The digital mix has significantly improved. I remember reading one note before COVID happened, when the digital mix was only like I think it was in mid-teens or something, and so it has quadrupled essentially since then, tripled or quadrupled since then. More than half the company's sales are now digital, right? I mean, so. And I think it depends, so here's a digital mix. So you can see that this trend has been very, very strong. And then with some reopening theme, it came down naturally, but it still continues to hold up. So this is very, very strong tailwind in the long run. And you know what? That every single restaurant company that's out there that it needs to reinvent itself during this COVID mix has to basically find how to tap digital platform in order to continue to stay relevant essentially in this environment. And so this also means margin improvement in the long run because you do not have as much dining space being used, lower overhead cost, and faster deliveries and all that. So overall, the business trends continue to be very, very good with the digital mix improving. So with that said, I do think the company will post a very strong quarter. And frankly, I don't know how much of a pullback, if it does come, it's going to give. This chart has been very, very strong, and I've not seen any kind of negative news on this one or option flows or anything. So might as well just break out and make a run towards 1400 plus once the earnings report come out. Very difficult to enter from option trading standpoint, just because very wide bid and ask spreads and rather very expensive options. And so nevertheless, I do like the update, and I think this company is firing on all cylinders, and these checks just prove that. Good stuff, Chronicle. Thank you very much. All right, folks, we're going to stop over here. We'll see you in the chat room shortly.